Well, good afternoon and welcome to the next quarterly update of the tax and superannuation changes that we've been presented with over the past couple of months. Joining myself, Brett Griffiths, is Josip Matanovic to talk about the changes that we've seen, as I say, over the past couple of months that relate to tax and superannuation issues. So firstly, we'll start with Josip talking about the tax changes, and then from there we'll move on to the wonderful world of superannuation. So with that, I'll hand over to Josip.
G'day everyone. I guess we'll launch straight into it. On the 13th of May, the ATO released the Tax Determination 2015/11, which specifies that the car parking threshold from the FBT year that commenced the 1st of April 2015 is $8.37. That's up from $8.26 in the previous year. On the same day, the ATO also released the Luxury Car Tax Determination 2015/1, which states that the luxury car tax threshold for the 2015-16 year is $63,184. It said that the LCT threshold was to be indexed annually according to a factor to be determined by Parliament, or if such a factor is not determined by Parliament, indexed annually in accordance with movements in all groups' consumer price index. The determination also states that the fuel-efficient car limit for the 2015-16 financial year is 75,375. That remains unchanged from the previous year. With regards to the accelerated depreciation for small businesses, I guess the ATO has stated that they will start monitoring the behaviour in relation to the claims. The ATO has noted the 2015 federal budget proposal to allow small businesses with, I guess, aggregate turnover of less than $2 million to immediately write off assets they start to use or install ready for use, provided the asset costs less than $20,000. The proposal will apply for assets acquired and installed ready for use between 7:30 p.m. on the 12th of May and the 30 June 2017. The ATO has noted that the rules around asset eligibility do not change. That is, if an asset was eligible for immediate tax deductibility under the current $1,000 threshold, it will continue to be deductible under the new proposed $20,000 threshold. However, to ensure the proposal operates as intended, the ATO said it will engage with small businesses based on their behaviour and choices. It said this will include providing clear guidance so that businesses intending on utilising provisions find it easy as possible to do so. The ATO said if small businesses exhibit behaviours that indicate a high level of risk, they can expect a higher level of interaction from the ATO.
And yes, I suppose it's worthwhile just mentioning on that too, that provision does not apply to self-managed super funds because they're not carrying on a business. So just something to bear in mind. The Australian Charities and Not-for-Profits Commission has noted that the federal budget for 2015-16 confirmed that the regulator should continue its work according to the current priorities, whilst the ACNC Act remains in effect. There is provision for continuing budget for 2015-16 and into the forward estimates. Following from the March quarter update that we had earlier in the year, the ACNC has also provided an update in relation to the 6,000 double defaulters. Following personal letters to these charities from the ACNC, 1,000 of these charities have now retained their charity registrations by submitting overdue 2013-14 annual information statements. A list of these double defaulters is now on the ACNC website. Please note that the 2014 annual information statements were due by 30 June 2015. Now this one is for those of us who have clients that own property or are looking to purchase property in New Zealand. The 2015 New Zealand budget was handed down on the 21st of May and announced that the New Zealand government is taking extra steps to bolster and enforce the tax rules on property. Subject to consultation from the 1st of October 2015, all residents and New Zealanders buying and selling any property other than their main home must provide a New Zealand IRD number. All non-resident buyers and sellers must provide their tax identification number from their home country, along with the current identification requirements such as a passport. To ensure New Zealand's full anti-money laundering rules apply to non-residents before they buy a property, non-residents must have a New Zealand bank account before they can get a New Zealand IRD number. A new bright line test will be introduced for non-residents and New Zealanders buying residential property. Under this new test, gains from residential property purchased on or after the 1st of October 2015 and sold within 2 years will be taxed unless the property is the seller's main home, inherited from a deceased estate, or sold as a part of a relationship property settlement. The government will also investigate introducing a withholding tax for non-residents selling residential property to be introduced in mid-2016 after the consultation. So the ATO, think Uber and Airbnb. The ATO has released information providing its view of the tax obligations of people providing services in the sharing economy. It said that the people engaged in sharing economy activities, things like sharing a car or providing a taxi service or letting out a private room, may have some tax obligations. Some of the key points that they've raised, some of them seem quite obvious. Income tax providers, income tax obligations for providers. People who are earning assessable income from providing sharing economy services will need to keep records of income from that activity and any allowable deductions which may need to be apportioned for private use. Some GST implications for providers. For those that are already registered for GST for another purpose, the activities in their sharing economy enterprise must be included with their other activities. People need to register for GST if their annual turnover from their sharing economy enterprise is $75,000 or more. However, note if they're providing taxi travel, they must be registered regardless of their turnover. Taxi travel service, I'll continue with that through, I guess, ride sourcing. So this is the Uber type arrangement. The ATO has released further guidance for people providing taxi travel services through ride sourcing. The ATO has confirmed that people who provide ride sourcing services are providing taxi travel under the GST law. It said that the existing law applies, and so drivers are required to register for GST regardless of their turnover. And then the ATO is allowing drivers until the 1st of August 2015 to obtain an ABN and register for GST. The ATO said it does not intend to apply compliance resources regarding GST obligations for drivers prior to the 1st of August 2015, except if there is evidence of fraud or any other significant matters. I'll go on to renting out part or all of your home. I guess the ATO has released further information for people renting out part or all of their home. The ATO said rent money received is generally regarded as assessable income. The ATO also noted that these people may not be entitled to the full CGT main residence exemption. The ATO also noted that GST does not apply to residential rents. This is just one I've thrown in. I guess it's in relation to, I guess, the ATO reporting sometime in April that there were 434 registered tax agents who had failed to lodge their own outstanding obligations despite being issued with lodgement reminder letters and phone calls. These agents were issued final notice of intention to prosecute. It said if these agents do not lodge their obligations immediately, the ATO will commence court proceedings, which may result in criminal conviction, fines and court costs. After successfully prosecuting a registered agent, the ATO said the agent will be referred to the Tax Practitioners Board, which I assume will lead to a suspension of their tax agent registration. This one's in relation to, I guess, the Tax Practitioner Board providing some guidance into whether labour hire firms are required to be registered as agents with the Tax Practitioner Board. Generally, the Tax Practitioner Board considers that where a labour hire firm is merely sourcing a candidate for a client and the client is fully responsible for the employment or engagement of the candidate, including remuneration, then the labour hire firm does not need to register with the Tax Practitioner Board. This is because the labour hire firm is providing a person rather than a tax agent service. However, if the labour firm is involved in placing a candidate with a client to provide tax agent services, and it is responsible for the remuneration of the candidate and also for ensuring that the client is satisfied with the services provided by the candidate, then the labour hire firm will most likely need to register with the Tax Practitioner Board. In this case, the labour hire firm is considered to be providing a tax agent service rather than merely providing a person. The Tax and Superannuation Laws Amendment 2015 Measures Number 1 Bill for 2015 was introduced or proposes the following amendments. Abolishing the dependent spouse tax offset. It amends the 1936 Act and the 1997 Act to abolish the offset, expand the dependent invalid and carer tax offset by removing the exclusion in relation to spouses previously covered by the dependent spouse offset. It also removes the entitlement for the dependent spouse tax offset where it is made up of made available as a component of another tax offset, and replace that component with a component made up of the dependent invalid and carer tax offset. It also rewrites the notional tax offsets covering children, students and sole parents that are available as components of other tax offset. This amendment applies from the 2014-15 year and all later income years. The bill also amends the investment manager regime. It amends the 1997 Act to implement the third and final element of the investment manager regime reforms. The IMR reforms are designed to attract foreign investment to Australia and promote the use of Australian fund managers by removing tax impediments to investing in Australia. The changes apply in relation to the 2015, 16 and later income years. In addition, taxpayers may choose to apply some of the amendments to previous income years. It also goes about modernising the offshore banking unit regime and makes a number of reforms to modernise the offshore banking unit regime. The reforms include measures implementing recommendations of the Johnson Report. The reforms also include targeted amendments to address a number of integrity concerns with the existing regime. These changes apply from the 1st of July 2015. The bill also covers the income tax exemption for the Global Infrastructure Hub Limited. It amends the 1997 Act to exempt the Global Infrastructure Hub Limited from liability to pay income tax on ordinary income and statutory income. It applies from the 24th of December 2014 to 30 June 2019. It also includes a cessation of the first home saver account scheme. It repeals the legislation providing for the scheme, including the related tax concessions. It applies from the 1st of July 2015 for accounts opened in respect of applications made before the 13th of May 2014, 7:30 p.m. Generally, accounts opened after this date will not be eligible to be first home saver accounts. The repeal of the tax concessions applies to the 2015-16 year and later income years. There's also just a few other miscellaneous amendments as well as, I guess, an update of the deductible gift recipients register. So I touched on this before, but the Tax Laws Amendment Small Business Measures Number 2 Bill for 2015 proposes to amend the accelerated rules for the small business. Their businesses with an aggregate turnover less than $2 million by temporarily increasing the threshold under which certain depreciating assets, costs incurred in relation to depreciating assets and general small business pools can be written off. The increased threshold is $20,000 and would apply from effectively the time of budget night up to 30 June 2017. From 1 July 2017, the threshold will revert to the existing $1,000. The increased threshold is available to small businesses, including those who previously opted out of the simplified depreciation rules. I'll go on further. Assets that do not qualify, do not satisfy these timing requirements would continue to be subject to the existing $1,000 threshold. The requirement that an asset must be first acquired at a particular time is not a feature of current subdivision 328-D and is an additional requirement for the increased threshold to apply.
This additional requirement limits the access to the increased threshold to small business entities' new assets, requiring a depreciating asset to have been first acquired by the small business entity is designed to ensure that assets cannot satisfy the acquisition requirement if they were previously acquired at an earlier time, temporarily disposed of, and then reacquired at or after 7:30 p.m. on budget night. Further, the bill goes on to amend the 97 Act to allow primary producers to claim an immediate deduction for capital expenditure on water facilities and fencing assets, and to deduct capital expenditure on fodder storage assets over 3 years. Again, this applies from the budget night, so 12th of May at 7:30 p.m. So we see this every year. I guess the ATO is coming out with, I guess, what they'll be focusing on for the 15 year. They'll be focusing on unusually high work-related expense claims across all industries and occupation, which is, I guess, much wider than it has, much wider scope than it has been in previous years. In addition to focusing on work-related expense items or expense claims that are significantly higher than expected, the ATO will be paying particular attention to claims that have already been reimbursed by employers and for private expenses such as travel from home to work. The ATO have also said that they'll be focusing on rental property deductions and is encouraging rental owners to double check their claims are correct before lodging their tax returns. The particular focus the ATO is having is, I guess, excessive deductions claimed for holiday homes, husbands and wives splitting rental income and deductions for jointly owned properties that is not supported, claims for repairs and maintenance shortly after the property was purchased, and interest deductions for, claimed for private proportion of loans. So the Tax Laws Amendment, the Small Business Measures No. 1 Bill for 15, it comes out of the, I guess, the announcement on budget night. It implements the 2015-16 budget measures by amending the income tax rate, the Income Tax Rates Act of 1986, to reduce the company tax rate from 30% to 28.5% for companies that are small business entities with an aggregate turnover of less than $2 million. The company tax rate for corporate unit trusts and public trading trusts that are small business entities will also be reduced to 28.5%. Further, the maximum franking credit that can be allocated to a frankable distribution will remain unchanged, so the same rate of 30% will continue to apply to all companies. The term small business entity takes its meaning from section 328-110 of the 97 Act and includes the requirement that an entity must have an aggregate turnover of less than $2 million in the previous year and are likely to be under the turnover threshold of $2 million for the current year. These amendments apply from the 1st of July 2015 and for subsequent income years. Basically, with the treatment, the company loss rules were repealed back in 30 September 2014. The repeal applied from the start of the 2013-14 income year for most taxpayers. However, it applied from the 2012-13 year for taxpayers with certain late balancing substituted accounting periods. The ATO is in the process of contacting companies that have claimed the loss carryback tax offset that they were no longer eligible for. The ATO's process is to remove the offset from the affected assessment and send the company a notice of amended assessment. The ATO states that these taxpayers should review the amount of losses carried forward to later income years when they lodge their next tax return. So with the 2015 tax season upon us, here are some key changes that I guess taxpayers need to be aware of this tax time. They include the temporary budget repair levy, the Medicare levy increase to 2%, net medical expenses tax offsets being phased out, the mature aged worker tax offset has been abolished, dependent invalid carer tax offset name has changed, the small business concessions, R&D tax offset changes, SMSF changes with, I guess Brett will cover.
Yeah, demarcation dispute there, yeah.
Okay.
and the notice of assessment and tax receipt delivery for MyGov account holders. So just expanding on that, if your individual clients have created a MyGov account and linked it to the ATO, they'll receive their notice of assessment and the tax receipt and other mail direct to their MyGov inbox. Any mail received by your clients via their MyGov inbox will no longer be sent to you in paper form. I guess by linking the ATO to their MyGov account, your client has agreed to receive the ATO correspondence in their MyGov inbox instead of sending the mail to us as registered tax agents. You can view your individual client's mail in the tax agent portal via the client correspondence list. The income tax effective life of depreciating assets determination of 2015 was released, providing taxpayers in specific industries and for specific assets with effective lives as to a basis to calculate the decline in value or the depreciation of an asset for income tax purposes. It commences on the 1st July 2015. And this one's for, I guess, your clients in the building construction industry. The ATO has reminded tax professionals that the 2015 taxable payments annual report is due the 28th of August 2015. The ATO is contacting taxpayers in the building and construction industry who may have made payments to contractors for building and construction services in 2014-15. To assist with completing and lodging the taxable payments annual report, the ATO is hosting 1-hour webinars running from now right up until the end of August 2015. So this is just expanding on, I guess, the previous update in March where the employee share schemes changed. I guess following on from that, the Minister for Small Businesses announced from the 1st July that start-up companies can use a standard template created by the tax office to offer employees options in their company. The templates support the recent tax changes made to the employee share scheme framework. The ATO has made available templates for an employee option plan and employee letter of offer. Employers can download the templates from the ATO website, fill in the blanks and offer their employees options to buy shares in the company. Further, the income tax assessment methods for valuing unlisted shares approval for 2015 sets out methods that can be applied by some companies that issue employee share scheme interest and that need to work out a market value for the purposes of complying with the employee share scheme provisions. The approval commences on the 1st of July 2015 or on commencement of that act, whichever is later. So some of you may, I guess, remember sometime last year that professional services firms were issued a guideline in terms of the, I guess, appropriate distribution of income, making sure that it, there was appropriate compensation for the work provided by the main principal in I guess, the professional services practice. Following on from those draft guidelines around issued around that 12 months ago, the ATO has now finalised its guidelines on how it will assess the risk of Part 4A, applying to the allocation of profits from a professional firm carried on through a partnership, trust or company where the income of the firm is not personal services income. The ATO says it has formulated these guidelines after extensive consultation with the legal and accounting professional bodies, and as a result the guidelines apply to relevant arrangements within professional services firm, including but not limited to those providing services in the accounting, architectural, engineering, financial services, legal and medical professions. The ATO says the guidelines only apply to tax compliance risks arising from the particular commercial and regulatory context for professional firm arrangements. The revised guidelines apply from their date of issue, that's the 30th of June, for the application of ATO compliance resources in the 14-15 year and beyond. However, the ATO says it is committed to reviewing them during the 2016-17 year, subject to the possibility of judicial guidance pending an appropriate test case being identified. The guidelines look at individual practitioners who provide professional services, legally effective partnership, trust or company, income of the firm that is not PSI, what the ATO's concerns are, the ATO risk assessment factors for remuneration of individual professional practitioners, and additional information on the application of benchmarks. So amendments contained in the Tax and Superannuation Laws Amendment 2015 Measures Number 3 Bill 2015. It's still before Parliament. We mentioned it in the last update. Essentially, it proposes to change the rates of assistance under the R&D tax incentive to 43.5% for eligible entities with a turnover under $20 million per annum and not controlled by an income tax exempt entity, and 38.5% for all other eligible entities. This change will apply from 1 July 2014 with the rates of assistance currently legislated at 45 and 40% respectively. The ATO is now advised of, I guess it's administrative treatment of the measure until enactment of the changes to the law. The ATO says its systems will automatically apply the R&D offset rates specified in the existing law, and assessments will issue accordingly. If the changes to those rates are enacted, so falling to I guess 43.5% and 38.5% respectively, affected taxpayers should seek an amendment to their assessments. The ATO says no penalties will be applied for the tax shortfall arising from the result of the changed rates, and any interest accrued will be remitted in full up to the date of enactment of the law change. In addition, any interest accruing after the date of enactment will be remitted where taxpayers actively seek to amend assessments within a reasonable time frame after enactment. So this one's for the tax agents out there. I guess the ATO has advised the lodgement program performance summaries will be sent to tax agents over the next few weeks. The ATO asked that to ensure that they receive their summary, the agents check that their email address is correct and they're all up to date. The annual lodgement program performance summary lets agents know how they are performing against the 85% on-time lodgement performance requirement. The ATO says it will only use current year returns to calculate this on-time performance percentage. So that's about it from me. What I'll do is I'll pass over to you.
Thanks, Joe. Now, fortunately, for the last couple of months, there hasn't really been any legislative changes in relation to super, which is always a nice change. However, that doesn't mean that there's been inactivity, especially from the tax office. So the first one really relates to SuperStream. Now, we've been talking about SuperStream for quite some time. What the ATO have done is essentially provide a grandfathering provision or a deferment in the relation to the being compliant for SuperStream. So as a bit of a recap, SuperStream is designed to provide a way in which data can be transferred from the employer to a superannuation fund. And the idea behind that is to eliminate a lot of the manual back office processes that existed essentially through the Henry Review going back a while. So basically with SuperStream there's two components or two elements to it. So the first one is the employer compliance. So that's the starting point. The employer needs to be SuperStream compliant. So that may mean that they need to update their payroll software, to use an outsourced payroll function, use a commercial clearinghouse, remembering there is also the small business superannuation clearinghouse, which I believe is looked after by Medicare call centre. That's if you have less than 20 employees. And also a lot of default superannuation funds also have a clearinghouse type facility or a gateway where you pay them all of the superannuation, and from there they disseminate it to all the other super funds that your employees may wish to choose. So that's the first point of call, that the employer needs to ensure that they're compliant as well as their clearinghouse and any payroll facilities providers that they may use getting money to superannuation. And then of course there's the superannuation fund itself. So large super funds will already be SuperStream compliant because that actually should have happened November 2014. So all that they really need to do is provide, or is you to provide them with the electronic service address. So with self-managed super funds though, they actually need to register to obtain that electronic service address or ESA. Now, it's important, I suppose, to know that all of Vincent's self-managed super funds that we look after here, they're all registered for SuperStream, so you only need to make touch base with us and we can easily enough provide you with a basic form that will give your employer all the information that you need, so then they can then become SuperStream compliant for your situation. If a self-managed fund is not SuperStream compliant, the employer should not pay to that self-managed fund, which means that ultimately you'll end up with your contributions going to a default superannuation fund. Therefore, you'll have now 2 superannuation accounts and additional costs and so on and so forth. So just something to bear in mind with that. Now, as far as the employers go, employers with more than 20 employees, they technically should have already been compliant with SuperStream. However, the ATO is giving them a little bit more time, as I mentioned before, up until 31 October. However, to satisfy that extension, the ATO is wanting to make sure that the employer is actually making genuine attempts to be ready. Now, if you have a look at the SuperStream portion of the ATO website, they have some good checklists and things to consider as part of being SuperStream ready. They would at the very least expect an employer to have gone through those items, and they actually suggest that it will take 3 months to become fully compliant with SuperStream from scratch. So if you, as an employer, if you haven't started, then you really need to get that process moving. For a self-managed fund, while they should have actually been registered for 1 July, once again the ATO is essentially allowing a soft lead into it, so that you actually have to have until 30 June 2016 to be fully SuperStream compliant. Once again, the self-managed fund has to show genuine intent that they actually plan on being compliant with SuperStream. There's a number of different options. Australia Post is certainly one, plus there are a number of different other service providers out there. They are available on the ATO's website if you are looking for a provider for SuperStream for either your clients or for yourselves personally. Something just to bear in mind is that the preservation age, which is the age in which you can essentially start to access your superannuation, generally speaking, those changes are now starting to flow through. So about 10 years ago, these changes were originally introduced that allowed a transition period in which point the age of preservation, so the age in which you can start to access your superannuation generally, increases from age 50 up to age 60. So it's a progressive thing. So essentially any person that was born before July 1960 could access their superannuation at 55. And that's a number that everyone's very comfortable and very familiar with in relation to accessing your superannuation. However, anyone who is born after 1 July 1960, so essentially anyone who is about to turn 55, they actually have to wait until they turn 56 at least to access their super. So one of the staff members here, her parents actually both turned 55 this year. One is before 30 June and one is after 30 June. So in that situation, the parent who turns 55 before 30 June can access their super now, while the other parent has to wait another 12 months. So it's just one of the anomalies, but ultimately there is a cut-off point. Now if you are interested in playing superannuation bingo, there has been a lot of press about the increasing of the preservation age from 60 to 65 and how that will actually save the country about $7 billion in tax. So that is something that's likely to come out in the white paper, green paper review that's going on at the moment, increasing that preservation age to age 65. Once again, I expect there'll be a long lead time to allow sufficient planning for that sort of thing. Commonwealth Seniors healthcare cards, it's worthwhile, I suppose, just revisiting this. It's something we spoke about a little while ago, but just once again going over that from 1 January 2015, any new account-based pensions or transition retirement pensions, they become subject to special deeming rules in relation to calculating income for the CSHCs. Now, what that really means is that if you had a pension that was prior to 1 January 2015, it was grandfathered. So that means that the income is not deemed. It essentially doesn't exist for the calculation of income for the CSHC. Obviously, if it's not grandfathered, then you're ineligible. So it's just calculated as normal the deeming provisions for income. So to be eligible, firstly, the pension or pensions had to exist prior to 1 January 2015, but also you would have had to have actually held a Commonwealth Senior Health Card prior to that date and essentially continue to hold it. So they're the key criteria to start with before you get too caught up with, do I have a new pension or a grandfathered pension? But what does it really mean? Well, new pensions can essentially take shape, have a number of different forms and substances as to how that can actually occur. So any pensions that are combined from other accumulation monies or other pension monies. So for argument's sake, if you put money into superannuation, you stop an existing pension, combine those monies together and then start a new pension, hence the stop and restart, then that is a new pension. So you've potentially changed a grandfathered pension into a new pension. Similarly, if you have two pension accounts that you want to merge for whatever reason, then that is a stop and restart. If the member fails to take a minimum pension in a particular year for a pension, then that is actually a stop because the pension ceases to exist. So that means that come 1 July of the following year, the pension recommences if that's what the member chooses, which means that that is a new pension. So once again, the grandfather pension is relinquished because they haven't taken enough minimum pension for that financial year. Rolling money between existing superannuation funds. So if you have a pension in one super fund and you wish to roll that to another fund, so for argument's sake, if you're in a self-managed fund and you wish to roll that to a industry fund, then that rollover is actually stopping an existing pension. When it rolls into the new industry super fund, it goes in an accumulation and then a pension is started from there. So once again, that's a stop and a restart of a pension. So the grandfather provision is lost. Obviously, new monies that put into superannuation, if a pension is commenced on that, that is also a new pension. And death benefit pensions. So if you have a situation where you have a husband and wife, for argument's sake, in sort of self-managed fund, and the husband is on a reversionary pension, when he passes away, it reverts to the spouse, to his wife, then that is actually a continuation of the existing pension. So that's grandfathered. However, if there wasn't a reversionary pension in place, so in other words, the trustees make a determination to pay a death benefit pension, assuming the trustee allows for it, then that actually becomes a new pension, so non-grandfathered. So a couple of tips and tricks there to look out for when you're looking at your own circumstances or that of your clients in relation to handling pensions. So it will mean some changes for how things have been done in the past potentially, and it's always something that needs to be considered as to going forward when dealing with clients and their pension accounts. Because remembering that particularly inside a self-managed fund, you can have as many pension accounts as you like, but you can only have one accumulation account. So losing the healthcare card, even just for 1 year, means that those grandfather provisions are also lost forever. So once again, because it's not a continuation of the card, so the existing pensions are now lost for their grandfather provisions. So what that means is that the income is deemed for all pensions. So if the healthcare card stops for whatever reason, so you have a large capital gain personally, and you lose your healthcare card, in a particular year, all your existing pensions are now deemed for income. So just something to bear in mind with that. Moving on to an interesting topic, QROPs. We've had a number of inquiries about this of late, and I'll touch on essentially why that is in a tick, but to cover off what QROPs is, basically it's the UK pensions. So when an Australian super fund receives UK pensions, they have to be a qualifying recognised overseas pension scheme, hence the acronym QROPs. So essentially it's an overseas, it's a superannuation fund in Australian terms that meets the same requirements as set out by the UK government. And this is essentially why we're seeing an increase in popularity with it. That basically in the UK land, pensions can be taxed at up to 45% on income, on death of the member, and also after someone turns 75. So they really lay their teeth into the tax. When you consider here in Australia, it's basically tax exempt after age 65, assuming the pensions are commenced. So very different schemes. So there's a lot of interest in moving UK money to Australia. Now there can be tax on doing that in Australia, so I'm not touching on those situations. It's just something you need to be mindful of. They are assessed against the non-concessional caps, and you still have to meet work tests and things like that potentially if you're over 65. But more specifically, I want to touch on the changes the UK government has made that it's causing some grief, to say the least, here in Australia. So in April, they changed it so now basically their members were permitted to take pensions as a lump sum. Previously they were limited to 25%. However, what that has meant is that they've placed a ban on anyone withdrawing money who's under the age of 55, with the only exception to that being payments of ill health benefits. Which on the face of it, you all think, yeah, look, that's fine. Australia, we can't access our money to 55. I was just going through the preservation age and so on and so forth. But there are a lot of conditions of release that we have here in Australia that actually allow us to access money early. So for argument's sake, financial hardship. If you're on Centrelink benefits for 26 continuous weeks, you're able to access up to $10,000 of your superannuation potentially. So that immediately falls foul of these arrangements. So if a superannuation fund allows that provision, then they can't be QROPS compliant. So that means that a trust deed needs to be structured very particularly to ensure that it is QROPS compliant. But even then, there are certain aspects within our tax law, such as the release of benefits to pay excess contributions tax, means that you can't draft a trust deed around those things. So this is an area that there's still been a lot of discussion on and a lot of uncertainty about. Because essentially what it means is that if you transfer money from the UK to Australia, then if it's not held on the same terms, then there's some significant tax to pay of up to 55% of the money that's been rolled over. So they don't miss you. So it's typically you're not talking about small licks of money with these. So it's something that really needs to be considered very carefully. Now, even if you believe that your trust deed is compliant, that doesn't necessarily mean that the UK fund will actually release the money, because they have a website that lists all of the QROPS compliant pension funds or superannuation funds throughout all of not only Australia's ones but also the world. There was something like 1,600 Australian super funds listed, and now there's one, and that's a local government fund for whatever reason. So, and before people start to think of some great ideas about rolling it into one super fund and then moving it into another fund, like a self-managed fund, to get around some of this, then basically the reporting requirements and the tax requirements follow that flow of money for 5 years. So there's no point trying to basically weave it in and out of superannuation funds to avoid these measures. So it's an evolving space, Her Majesty's Revenue Service met with our Treasury 2 weeks ago to discuss this issue and to talk about it. So there are some high-level discussions going on. Hopefully we'll have a favourable resolution as to being able to continue what's been happening for quite some time. Another thing that I thought might be interesting for those listening this afternoon is binding death benefit nomination case out of Victoria, whereas essentially there was a family dispute over super death benefits, which basically has meant that there's over $370,000 legal bill that's been racked up in defending this case. So a very quick synopsis of the situation was that the deceased had a binding death benefit nomination in which 2 adult daughters from his first marriage were nominated, and the wife from his second marriage disagreed with that. Now, unfortunately, the wife had control of the corporate trustee as sole director, so she did not wish to pay out the binding death benefit nomination as it was nominated. So via this court proceedings, the Supreme Court of Victoria essentially upheld the validity of the binding death benefit nomination and said that, yep, the super fund has to pay out those death benefits to the 2 adult daughters, being some $924,000 plus almost $300,000 of interest owing. However, the now replaced corporate trustee had racked up bills of over $370,000 plus unbilled fees of another $160,000 in essentially defending this binding death benefit nomination claim. So where it's at the moment is the Supreme Court of Victoria has ruled that the fund's current trustees, who are the adult daughters, funnily enough, now have the right to seek a review of the legal costs incurred by the super fund. So what that essentially means is that if that review deems that those costs were excessive, that the trustees were doing more than what was reasonably prudent, then the director of the corporate trustee, aka the second wife, now is personally liable for those costs. So what do we learn from this? Well, having binding death benefit nominations is a great thing. However, you also need to ensure that the person who is receiving those nominations also controls the purse strings. So if they don't have control of the trustee, then that's only essentially half the battle. Also, it goes to show that if everyone gets along and everyone understands who's to get what, then people will be better off financially, potentially, anyway. Because remember, sometimes it's more than about the money. And money does do strange things to people as well. A few other things just to note as we're trucking through. The supervisory levy, in the past 2 years we've actually been paying in advance. So the normal levy of $259 has been split in 2 because we've moved from an arrears to an advance arrangement. So what that means is that any new funds for 2015 have to double pay. So they're paying $518 this year, and then they pay $259 the following year, with the intention being that in the year of wind-up, you actually don't pay any levy at all. Very minimal changes to the tax return or the annual return for self-managed funds for this year. So as Josip mentioned earlier, we now have the ability to record bank account details and for electronic repayment or receipt of co-contributions and low-income superannuation contributions, as well as a separate area if you just want the tax return going to another bank account. So you can actually split those payments out. So particularly for either segregated assets or pension accounts, that may be of relevance. Also in the tax return we have the ability to record that electronic service address. Now interestingly, the ATO is going to be using this to send electronic advice in relation to the super payments that are made to super funds. Now obviously not all super funds will need to have an ESA at this stage. In fact, most won't, in my experience. So that means that the ATO will still send out manual remittance advices in relation to those. So the annual statement of accounts, that will still happen via paper. However, this is all part of the ATO's push to become more electronic and more online. Not that dissimilar to the MyGov concept that Josip mentioned before in relation to personal assessments. In similar vein to Yo's tax agents not lodging their returns, the ATO conducted a trial of some 40 auditors to double check that the returns that are being credited to being lodged with those SMSF auditors, the auditor actually knows that they have done the audit on and lodged. Now, very scarily, 50% of those auditors, so 20 out of the 40, reported there being some sort of inaccuracy or anomaly with the data that the ATO provided as opposed to their own records. Now, this may have been due to a timing issue, so in other words, the tax agent lodging a tax return prior to the audit, which should not happen. But more scaringly, I believe that there will be a number of self-managed super fund tax returns being lodged with no audit ever actually having been undertaken. So based on this trial, I would expect the ATO to dig a little bit further and essentially look at a way in which the auditor needs to report when and what funds they are auditing, so that way they can cross-match to see what's going on. Because the ATO very heavily use the SMSF auditor as a conduit to weed out any improprieties that's going inside a self-managed fund. Now, if returns are being lodged without that prudential review or process occurring, then it throws into question the integrity of that actual self-managed super fund return. So I'm expecting that will be a project the ATO will probably look to kick off in the next 18 months, funding permitting.
Thanks, Brett. All done for super. So just going through our upcoming webinars, I guess the next one's on the Tuesday, 28th of July at 12 p.m. Peter Haley and John Fine will be presenting on resolving financial disputes. The one after that's on the 11th of August at 12 p.m. Presented by Mark Alara and David Cody, and it's understanding financial options of aged care. So on behalf of Brett and myself, we'd like to thank you for listening in today, and until next time, thank you.